Yeah, so I think what a lot of people struggle with is the valuations that a number of the stocks we're talking about trade at. And I can completely understand that. I mean, so I think what we generally find is most people understand these are the areas of growth in the world and they want to invest in them, but they can't bring themselves to invest in the company. And the thing that's stopping them doing it is the short-term multiple. They're looking at next year's multiple and they seem to think that is going to stop them from making money on a certain investment. And we just bring this all the way back to what we said at the start and what we've said numerous times since we formed Munro Partners. Investing is actually a game of very few winners and thousands of losers. Your job is to find those very few winners. And in many studies that we've looked at over the years and we've flagged, can flag that literally 50 companies in the United States out of 25,000 that listed are responsible for nearly half the value created. So it is these very few companies that you're looking for. And as your global growth investor, our job is to really try and find the next ones that are going to come along. We know who the good ones are today. Our job is to find the next ones. And so when you're doing that analysis today, that inevitably leads you to the tech sector. So technology is what everyone gets hung up about. They get hung up about the rapid appearance of some of these companies that we've seen over the last 20 years, whether it's Google or Facebook or Netflix or now Zoom videos. And I think what a lot of people are missing under the surface is this is all happening because this is effectively the revolution of our lifetime. It is the acceleration of compute power that is occurring, which is allowing these companies to do more and more things. And so as much as we all love Zoom, the beauty of Zoom is that it actually works. And the reason why it works is because computers have got faster. And so what we know going forward is computers will continue to get faster, and so disruption should accelerate. And so what we've seen in the last 20 years is a huge period of disruption that inevitably, if computers get faster because of Moore's law, should accelerate in the next 20 years. And so when you think about that acceleration and disruption, the real way to win in the future is to spend. It's to spend money. You need to spend money aggressively to build out your product. Your product needs to be one of these very few winners. And the way to do it is to spend aggressively. We show it here on R&D expenditure. But you could also do it on essentially CapEx, etc., building car plants, etc. But all of that is required to enable you to disrupt your peer. And so the last thing we'd say about this is if we go back over the last 10 years and we look at every company that went up nearly 10 times in value. So if we take the peak of the market in 2007 to the peak of the market in 2020, and we basically say which companies went up 10 times in value over that time frame. Not the companies that went from the bottom of the market to the top. They're the value investments. The ones that went from the top to the top. They're the ones we're looking for. They're the guys who win no matter what. And over that period, there was actually 66 companies in the S&P 500 that went up 10 times in value. And when you look at them versus their peer group, they are those exceptional few that we're looking for. All of them, more than 80% of them, have revenue growth of more than 10% per annum, with the vast majority having revenue growth of over 20% per annum. And in most scenarios, you had to pay multiples higher than the market. You had to pay, in many cases, over 50 times earnings and in many cases, loss-making. So if we know going forward that disruption accelerates, and we know that you have to spend to win from that disruption, then we just think it's somewhat inconceivable that you're going to find this future generation of companies trading at PE multiples of, say, 15 or 20 times earnings. You're going to have to look at loss-making companies. And not only that, you're going to have to take a longer-term view because you want your company to be spending to win. And so the last thing you should look at the short-term multiple, because the short-term multiple is effectively a shortcut to what is the right valuation for the company. And so that's what we think about when we think about using short-term multiples will not help you find long-term winners. You just quite frankly have to do a bit more work and you have to think about trying to find what you'd have to do to find those exceptional few. And that's what we can hopefully provide as your growth investor.